An old recession boogeyman, the inverted yield curve returns, and it's spooking some investors. Stock investors aren't supposed to be superstitious, but some market boogeymen are known to predict recessions with impressive accuracy. One of them returned. In good economic times, yields on government bonds tend to track an upward curve, since longer-term bonds carry a higher risk of inflation. The curve inverts. On Friday, the yield for 10-year treasuries fell below that for 3-month treasuries, marking the first appearance of such an inversion since 2007, months before the financial crisis triggered a stock market rout. If the inversion it finally happened. The yield curve 3-month bills/T-note has inverted. If it stays that while any near-term recession is unlikely to match the scale of the Great Recession of a decade ago, the appearance of the inverted yield curve triggered enough stock selling to send the S&P 500 index into its biggest one-day tumble since January. The S&P 500 dropped 54.17 points, or 1.90%, to 2,800.71, while the Dow Jones Industrial Average declined 460.19 points, or 1.77%, to 25,502.32. The Nasdaq large-cap tech and bank stocks were among those hard hit. Amazon fell 3. Not all investors regard a yield inversion as a harbinger of a recession, although the event has a rather unsettling track record of predicting recessions in recent decades. Every U.S. recession in the past 60 years was preceded by a negative term spread, that is, an inverted yield curve. Furthermore, adding to the selling pressure, Friday was a from IHS Markit that said the preliminary U.S. Manufacturing Purchasing Managers Index, which surveys companies on their business conditions, fell to 52.3, its lowest level in 21 months. Together with the economic data continue to signal slowing global growth, Catherine Mann, global chief economist at Citi, said in a research note. Dovish Central Bank.
Raindrop, drop top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park, pot.